Hi there, it's Friday the 13th of March 2020. I'm Steve Towers. Welcome to ITB. Let's get started. In the last week, governments in many countries have responded to the economic crisis caused by COVID-19 by announcing significant economic support packages for individuals and businesses. The support packages include a number of common tax elements. Firstly, a deferral of individual and corporate income tax payments. Secondly, a deferral of VAT payments. And thirdly, a reduction in VAT rates, particularly for heavily impacted industries such as tourism, transport and restaurants. Some countries have gone one step further and have announced substantive corporate income tax law changes. For example, Australia has announced changes in regard to accelerated tax depreciation and 100% expensing of asset acquisitions. Thailand has announced that SMEs will be able to claim a 300% deduction for salary payments and a 150% deduction for interest payments. And Italy has announced that a tax credit will be granted to companies which suffer a 25% fall in revenues. The OECD has released all of the public comments it has received in regard to its 2020 review of country-by-country reporting. But in view of COVID-19, it has cancelled the consultation meeting, which was scheduled for the 17th of March. For a copy of the public comments, please go to our website or app. In Australia, the High Court, Australia's final appellate court, has decided the appeal in the BHP Billiton CFC case against the taxpayer. This was an appeal by the taxpayer against the 2019 decision of the full federal court. Let me remind you of the case. You will recall that BHP Billiton has a so-called dual-listed company structure. The structure includes two listed public companies, BHP Billiton Limited, which is an Australian company and which has its primary share listing in Australia, and BHP Billiton PLC, which is a UK company and which has its primary share listing in London. Each of those two listed companies, which I will call Limited and PLC, has its own shareholders and its own subsidiaries and investments. However, there is a DLC structure sharing agreement between Limited and PLC, which requires them to operate as if they were a single unified economic entity through common boards of directors and a unified senior executive management. The case focuses on a company called BMAG, BHP Billiton Marketing AG, a Swiss company with a Singapore branch. During the relevant years, BMAG was 58% indirectly owned by Limited and 42% indirectly owned by PLC. BMAG was a central marketing entity for the DLC structure. Its profits were substantially derived from buying and selling goods between the DLC structure and third parties. Under Australia's CFC rules, BMAG was a CFC in respect of Limited due to the 58% indirect ownership interest. So the issue in the case was not whether BMAG was a CFC or not for Australian tax purposes. It definitely was. The issue was in regard to which particular transactions entered into by BMAG are taken into account under Australia's CFC rules, or, to use the technical expression, which of BMAG's transactions give rise to tainted sales income. And for that purpose, it had to be determined whether PLC's Australian subsidiaries were associates of BMAG, which is a defined term. And the critical definition was of the phrase sufficiently influenced. Under that definition, ACO is sufficiently influenced by BCO if ACO or its directors are accustomed or under an obligation, whether formal or informal, or might reasonably be expected to act in accordance with the directions, instructions, or wishes of BCO. The High Court held that this definition of sufficiently influenced does not require effective control. And based on the single unified economic entity and other requirements in the DLC structure sharing agreement, the High Court held that Limited was sufficiently influenced by PLC and PLC was sufficiently influenced by Limited. And based on Limited and PLC's shareholding in BMAG, the dual listing structure, and group-level documents issued by Limited and PLC, the High Court concluded that Limited and PLC sufficiently influenced BMAG. For a copy of both the High Court's decision and a summary issued by the court, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to the interaction of India's indirect share transfer provision, Section 911, and the capital gains article in the Belgium-India Treaty. A Belgium resident company owned an 11% shareholding in a Singapore resident company. The Singapore company, in turn, owned a 99% shareholding in an Indian resident company. The Belgium company sold its shares in the Singapore company for a profit. That profit was taxable in India under Section 911 on the basis that Explanation 5 deems the 11% shareholding in the Singapore company to be situated in India. The capital gains article in the Belgium-India Treaty, Article 13, is similar to the corresponding provision in the UN Model Treaty. Article 13.4 deals with the alienation of shares in a land-rich company and expressly allows indirect tracing of immovable property situated in the source country. Article 13.5 applies to the alienation of shares which are not covered by Article 13.4. If the participation is at least 10% in the capital stock of a company which is resident in the source country is permitted to tax the gain. And Article 13.6 is the residual provision. Alienation of any other property is taxable only in the resident's country. It was accepted that the Singapore company was not land rich, and thus Article 13.4 did not apply. The tax authorities made two main arguments as to why Article 13.5 allowed India to tax the gain. The first argument was that Article 13.5 allows a look-through approach to the 99% shareholding in the Indian company. The tribunal rejected that argument. It pointed out that Article 13.4 allows a look-through approach, as shown by the phrase directly or indirectly, but there is no similar phrase in Article 13.5. And the second argument was that the deeming effect in Explanation 5 of Section 911 also had the consequence that the Singapore company was deemed to be resident in India. The tribunal also rejected that argument. Explanation 5 deems the 11% shareholding in the Singapore company to be situated in India, but it says nothing about the resident status of the Singapore company. The tribunal's decision is consistent with the 2013 decision of the Andhra Pradesh High Court in the Sanofi case, which is currently on appeal to the Supreme Court. For a copy of the tribunal's decision, please go to our website or app. Also in India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to the Business Profits Article, Article 7 of the India-US Treaty. The taxpayer, a US resident company, had seconded a technical engineer to an Indian-related company. The contract between the two companies required the Indian company to pay a fee to the US company equal to the engineer's salary and related costs. In other words, on a pure reimbursement basis without any profit element. It was accepted that the presence of the engineer caused the US company to have a PE in India under Article 5 of the treaty. The tribunal held that the fee qualified as a fee for technical services under the domestic law and as a fee for included services under Article 12 of the treaty. Under domestic law, a fee for technical services is subject to gross level taxation. In other words, no deduction is allowed for expenses incurred in deriving the fee. So that would mean for the US company, it would not be allowed a deduction for the salary it pays to the engineer and for the other related costs. But the US company said, as the fee is effectively connected with a PE in India, Article 7 applies instead of Article 12. And Article 7.1 allows India to levy tax only on the profits, not on a gross basis. But the tax authorities then pointed to the particular language in Article 7.3, which states that in determining the profits of a PE, deduction of expenses is permitted in accordance with the provisions of and subject to the limitations of the taxation laws of the PE state. And the tribunal accepted the tax authority's argument that Article 7.3 allows India to impose gross level taxation on the fees in accordance with its domestic law. For a copy of this case, please go to our website or app. In Indonesia, the government has issued a regulation in regard to tax incentives provided in special economic zones. For a copy of the regulation, please go to our website or app. In New Zealand, the tax authorities have released for public comment a series of 5 draft public rulings on the New Zealand tax treatment of equity investments in US limited liability companies. Public comments are requested by the 17th of April. For a copy of the draft public rulings and a technical commentary, please go to our website or app. The European Court of Justice has also decided a case in regard to a secondment of an employee on a pure cost reimbursement basis without any profit element. The case concerns whether the secondment is a taxable transaction for VAT purposes. The secondment was between 2 related Italian companies. The Italian VAT law includes a provision which says that a secondment of employees on a pure cost reimbursement basis shall be disregarded for VAT purposes. The ECJ held that that provision breached the EU VAT directive. For a copy of this case, please go to our website or app. In France, the highest appellate court has decided that an Uber driver was an employee and not an independent contractor of Uber BV of the Netherlands. Commentators have said that apart from other additional costs, such as the need to comply with minimum wage rules, the decision will cause Uber a significant extra expenditure in regard to French social contributions. For a copy of this decision, please go to our website or app. Also in France, the tax authorities have released for public comment draft guidance on the French legislation which transposes the EU DAC 6 directive. Public comments are requested by the 30th of April. For a copy of the draft guidance, please go to our website or app. And similarly in Germany, the Ministry of Finance has released draft guidance on the German legislation which transposes the EU DAC 6 directive. For a copy of the draft guidance, please go to our website or app. In Luxembourg, the tax authorities have issued guidance on the country's CFC rules, which are effective for financial years commencing on or after the 1st of January 2019. For a copy of the guidance, please go to our website or app. In the UK, the government has presented its 2020 budget. Here are the items that caught my eye. Firstly, the government has announced in the budget the Conservative Party policy to maintain the corporation tax rate at 19%. This will require a legislative change, as the rate will fall to 17% on the 1st of April as the law currently stands. Secondly, the government has confirmed the introduction of a 2% digital services tax, effective the 1st of April 2020. A short policy paper on this topic was released by the government. For a copy of the paper, please go to our website or app. Thirdly, the R&D expenditure credit rate will be increased from 12% to 13% effective the 1st of April 2020. As this is an above-the-line item, the after-tax benefit will increase from 9.72% to 10.53%. The government has also announced a consultation on whether expenditure on data and cloud computing should qualify for the credits. Fourthly, tax depreciation will be available for certain acquisitions of intellectual property and goodwill which were created before the 1st of April 2002. Under current law, tax depreciation is available for IP and goodwill only if they were created on or after that date. The new rule will apply to acquisitions on or after the 1st of July 2020 from related parties which are outside the scope of UK corporation tax, subject to anti-avoidance conditions. And finally, from the 1st of April 2021, large companies will be required to notify the tax authorities when they take an uncertain legal interpretation which the tax authorities are likely to challenge. This new requirement will be in addition to the obligations on taxpayers and advisors under the UK legislation which transposes the EU DAC 6 directive on reportable cross-border arrangements. The government will shortly launch a consultation on the new notification requirement. For a copy of all of the tax-related documents released by the government, please go to our website or app. Also in the UK, the government has released a consultation document on the tax treatment of asset holding companies in alternative fund structures. Public comments are requested by the 20th of May. For a copy of the consultation document, please go to our website or app. And finally, in the UK, the Upper Tribunal has decided a case in regard to the interaction between a UK domestic law anti-avoidance rule and the Mauritius UK Treaty. A Mauritius resident company derived profits from UK sources. It did not have a PE in the UK, and therefore it was exempt from UK tax under the Business Profits Article, Article 7 of the Mauritius UK Treaty. The taxpayer in the case is a UK resident individual. Under a UK anti-avoidance rule, an amount equal to the profits derived by the Mauritius company were deemed to be income of the taxpayer. The taxpayer argued that the UK anti-avoidance rule cannot apply in this case due to the exemption under Article 7 and the paramount force given to the Mauritius UK Treaty. However, the tribunal rejected that argument on the basis that the anti-avoidance rule does not breach Article 7. The tribunal said this: the transfer of assets abroad provisions deem the profits of Mauritius Co. to be the income of the taxpayer, and then charge the deemed income of the taxpayer to tax. However, those provisions charge the income to tax as income of a miscellaneous character and not as trading profits arising to the taxpayer. The taxpayer is not relieved against that tax under Article 7 of the treaty because the UK is not taxing the profits of Mauritius Co, but is taxing something different, namely the deemed income of the taxpayer. It is nothing to the point that the deemed income of the taxpayer is computed by reference to the profits of Mauritius Co. As you would expect, the tribunal's decision relied significantly on the 1997 Court of Appeal decision in the Brycom case, which concerns the interaction of the UK's CFC rules and double tax treaties. For a copy of this tribunal decision, please go to our website or app. In Bahrain, the tax authorities have issued guidance on the VAT treatment of warranty repair services. For a copy of the guidance, please go to our website or app. In Brazil, the Supreme Court has held that export transactions which are conducted by trading companies are not subject to social contributions due to an exemption in the federal constitution. For a copy of the decision, please go to our website or app. In Peru, the tax authorities have issued guidance on the tax treatment of the distribution or deemed distribution of profits by a branch of a non-resident company. For a copy of the guidance, please go to our website or app. In the US, in the latest development in the Altera transfer pricing case concerning employee stock option costs, a coalition of 13 business organisations has filed a brief which supports Altera's appeal to the Supreme Court. For a copy of the brief, please go to our website or app. In Uruguay, the government has issued a decree which allows taxpayers to choose not to compute goodwill in certain corporate restructurings. For a copy of the decree, please go to our website or app. And now for this week's treaty developments. We've had one treaty signed and one treaty enter into force. I have 2 articles for you this week. The first article is called "May be Taxed for Whatever Reason, Conflicts of Qualification." The discussion is finished. It's written by Richard Xenophon Resch and is published in the Intertax Journal. This article revisits a controversial topic involving double tax treaties, namely how best to deal with the situation where the source country and the residence country disagree on the characterization of a particular item of income, which the OECD calls a conflict of qualification. As you know, the OECD commentary introduced an interpretation in the year 2000 under which the residence country is generally required to provide relief from double taxation under Article 23A or 23B for income which, under the source country's characterization, is covered by an article which says that the income may be taxed in the source country, regardless of the residence country's characterization of the income. That interpretation was challenged by several critics, including notably the late Klaus Vogel. The author writes this: "Critics of the OECD commentary's approach have at best accepted it as the lesser of 2 evils, but have not succumbed to its logic. In consequence, it is not understood by them as a mere clarification, but conceived of as a new approach that does not apply to tax treaties concluded before its introduction to the commentary. Despite attempts to diffuse the remaining issues that were diagnosed by Vogel, his argument has not been refuted to date. The purpose of this article is to re-examine the foundations of Vogel's critique and show that, contrary to his view, the OECD approach resolves all qualification issues." The second article is called "The European Union Directive, DAC 6, Compelling Advisors to Report Transnational Tax Schemes." It's written by Jacques Malherbe and it's published in the Tax Management International Journal. This article gives a good description of the EU's DAC 6 directive on disclosure of cross-border tax planning schemes. As you know, member states were required to transpose DAC 6 into national legislation by the 31st of December 2019 for application from the 1st of July 2020. The author covers these main topics: the definition of reportable cross-border arrangements, general, specific and transfer pricing hallmarks, intermediaries, taxpayers concerned, information to be transmitted, and procedural provisions. And he concludes by providing critical comments in regard to legal privilege, data protection, and the legal basis for DAC 6. Well, that's the way it is this Friday, the 13th of March 2020. I'm Steve Towers. Have a great weekend.